Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from Cerrado Gold. Cerrado Gold is traded on the TSX.V under the ticker CERT and on the OTCQX under the ticker CRDOF. And I'm joined today with the founder and CEO of Cerrado Gold, Mark Brennan. And Mark, always great having you on the show to get an update on the company. It's been a little while since we've talked, but it's only been a month. But in that time period, you had a lot of news, and we didn't actually get to discuss the Q1 financials. So I want to start there today and dig in on some of the key metrics from Q1. Now, in this quarter, you produced 11,163 gold equivalent ounces. You're still guiding for 55,000 to 60,000 for the year, but dive under the hood here with us, Mark, and take us through some of the key metrics and some of the key takeaways for investors.
Well, I think the most important thing, Shad, and great to be here again. But the important thing here is that we're really seeing this as a transitional period. First, second quarter, as similarly as we've had in the past, where basically operations are changing a little bit. We're focusing a lot more in the first half of the year on driving the production and the capacity of the heap leach. We've actually now completed bringing in the Sandvik heap leach crushers that we've had on site for a little while, and they're now fully operational. And the objective here is to make sure that we have the ability to generate 300,000 tons of ore to put onto the pad. In actual fact, now that we've put in the new Sandvik crushers that we've had, and with some other operational improvements, adding another line on the crushing units, we think our total capacity should get to about 450,000 tons on a sporadic basis. But really the objective is to drive that 300,000 tons per month, and that should throw off about 4,000 to 4,500 ounces of gold per month. So that's been a really strong push for us. And obviously we saw the heap leach having the biggest production quarter in the first quarter, and we still have a long way to go in terms of before we get to 4,500 ounces. But we're very comfortable with what we're doing right now to achieve that 55, 60,000 ounce guidance that we provided.
Well, and another area to maybe dive into is your all-in sustaining costs for the quarter. They're a little over $1,900 an ounce, but you have a target to get those down into the 1,500 to 1,700 range. Does that tie in with that secondary crusher you've just added? How does that fit into bringing the cost down?
Yeah, it does. And a few things. One thing is I omitted to mention that, with the new crushing units, we're actually bringing down the grind size. And so the ore that we're putting on the pad is going to be smaller granules. So from that perspective, we should find the residual time reducing as well. But, the biggest thing for us will be the unit costs will be the actual increase in production. And so producing 11,200 ounces in the first quarter, as we push that production higher, which again, as mentioned before, it's going to be strongly weighted to the second, third and fourth quarter, second part of the year. Basically, the costs are expected to come down to that 1,500 to 1,700 target zone. We've also gotten rid of a lot of rental equipment. We bought our own crushers, as we mentioned, and now we're getting rid of rental crushers that basically were costing us, $500,000 a month. So we're also looking to dramatically bring down our unit costs and likewise our overhead costs, operating costs at the site. So, increased units of production in its own right will reduce our operating costs, but we're also doing a lot to modify the operation to reduce costs further.
Well, and so it really seems like Q1, solid quarter, but Q2, you're going to have the advantages of the crusher and a lot of that rental equipment out of there, your own equipment. But then as you move into the end of Q2 and into Q3, you also put out some news on June the 12th, and it talks about how you've begun underground operations at Minera Don Nicolas. So maybe speak about how the underground operations will now augment some of the open pit and how that'll all tie into even increased production moving forward into Q3 and beyond.
Yeah, well, you may remember in the earlier days, we were producing a lot of ore from Paloma. And basically, what we did is we completed mining at the Paloma pit as an open pit operation. And now what we've been doing is we've just blasted a portal. We're going to be doing underground development. We'll be developing an ore, which we've already started. And so from that perspective, we anticipate bringing some good high-grade material into the CIL plant, which is largely running at less than capacity. So from that perspective, we've got a nice mill to run new ore through, and we see some really strong potential for significant ore to be run through the plant. So from that regard, we're very confident in our guidance, and actually we hope to not only improve the guidance with the production numbers, but also maybe even have some advantages with costs as a consequence of having higher grade material, bringing down our unit costs as well. So, we've never done any underground exploration at Minera Don Nicolas before. This is what all the other companies around us have done: Cerro Negro, Cerro Vanguardia, Cerro Moro. And this is kind of the next step in most of these companies' evolutions. And that's what we anticipate will be a big step for us moving forward. The production side, we're going to see some good additions to production, particularly as you mentioned, starting in the third quarter. However, really what another secondary objective is to enhance our resources by doing a fairly significant exploration underground. So the benefit of production is very nice. It adds to our production profile. Likewise, it reduces costs. But we're looking to really expand our footprint at Minera Don Nicolas with this underground material.
Well, let's give people a snapshot of what could be coming down the road as far as growth then, because I consider you guys a growth-oriented gold producer, Mark. And so the crusher is going to help in Q2. Having the underground material in Q3 and beyond will help. But what's possible as far as growing the annual amount of ounces produced? What do you think is possible?
Listen, I think in terms of, for those who have been following the company for a while, I mean, we acquired the project during COVID. It was a very, very difficult time. We haven't done a lot of exploration subsequent to our acquiring the project. And now we've brought in a new, very, very capable and very senior exploration geologist who's got a program of 20,000 meters that we've already started. And this is for open pit material alone. It doesn't include the underground material that we're expecting to be in addition to that. So I think, there is no reason. If you look next door at Cerro Moro, that are directly adjacent to us, or owned today by Pan American Silver, that formerly was Yamana. Basically, those guys were producing at one time about 150,000, 175,000 ounces of gold equivalent. And really, their mill was running at a 1,300 ton per day capacity. We have a 1,200 ton per day capacity with our mill, and they didn't have any significant heap leaching, which we have. So from that regard, I think that we could see a significant improvement and increase in production based on underground success. And everybody that we've brought in, consultants, et cetera, think that there's a very, very strong chance to significantly improve our resource just on the underground basis. Again, I mentioned to you, we have this 20,000 meter program, which is open pit resources, so a totally different objective there. Again, this higher grade material, when we were mining Paloma, we had anywhere from 8 to 12 grams per ton. So if we can get a little bit of ore coming out of the bottom of the pit, which is open and such, then we can drive a lot more capital very quickly. But the underground program should be able to, we see analog areas to Paloma. And so from that perspective, we're just hopefully seeing a string along about a 1.4 kilometer area that we strike, that we've actually done groundwork and geochem, et cetera, and mapping. And we think that has the same potential that we had at Paloma. So, I think we can be a producer much the same size as our competitors. And again, in our presentation, we've got a really great slide that shows how, we are the new kids on the block. We've been there since 2020 with COVID interruption, et cetera. We haven't been there a long time. And if you look at Yamana, when they got there, it took them a while to get up to their 150, 175,000 ounce production. And they've come off a little bit now, and I think they're running somewhere around 75,000 to 100,000 ounces. But in terms of, you look at Cerro Vanguardia, they've produced 8 million ounces. They started off with open pit, went underground, and had the heap leaching as well. So, we're following the same kind of footsteps as these guys. And I would say it's too early to rule out that we can't be the same size as these guys. I'm not saying we'll definitely get there, but there's no reason to suggest that we can't.
Well, and just remind people, when you get into this underground area, Mark, how deep do some of these mines go? Because again, you're just getting started, but remind us of your neighbors and peers just how deep some of those mines go.
Yeah, if I look at Cerro Vanguardia, I mean, they have a number of operations and underground areas within the Cerro Vanguardia project or property, but they're much deeper than we are for the most part. We're going to be, just below the pit floor. We're running probably at around 200 meters or just shy of 200 meters. So from that perspective, there's a long way to go before we get anywhere near as deep as our peer group. looking at Newmont and Newmont's Cerro Negro property, these guys are far, far deeper than we are, probably anywhere from 500 to 1,000 meters depth at this point.
Well, and then as far as the 20,000 meters in the open pit to expand that and look for new mineralization, that's another area. So, yeah, you got the combination factor of having the leach pads, but also the CIL plant for the underground. So, you got kind of a double whammy there. But what about the rest of the land package? Are there also regional targets you want to get after? Or?
Yeah, for sure. There's an abundance. Again, I just stress again, we're at the very, very early stages of this property's potential in our view. And so, for example, we're just right now, if you look at the open pit operations the exploration program we're doing now, they're basically less than 5 kilometers away from, between start to finish and that strike, they're less than 5 kilometers from Paloma. So from that regard, we have areas that are going up to 20 kilometers to the north. We've got areas which is where we find the heap leach. We have areas that are somewhat to the south of Paloma, anywhere from 3 to 5 kilometers. If we go down south, you've got the Nati prospect, which was one of Yamana's highest value targets, and we're directly adjacent to them, to that prospect on our property. So there's an abundance of targets. It is really just a prioritization issue where we focus most importantly to the closest to the existing operations, as that's the material that we can bring into the production profile as quickly as possible. So if you look at the underground operation, we haven't provided any kind of disclosure as to what our contemplation of potential is. Really, the reason for that is it's open a strike, it's open along depth in all different directions. So we're just not sure where that can go to. But the open pit operations in their own right, we think have the capability to add between 300 and 700,000 ounces. That's what we're targeting internally. So if we're able to accomplish that, that would take our mine life anywhere to 7-10 years at current production capacity rates. But our objective would be, throw the underground, compound that with the underground. There's no reason why we can't be producing at the same types of levels as our peers who have been next door to us.
Well, and I would also point out that even in the peers of the similar production profile, your valuation is still at a fraction of where other peers are. So you just have the ability to re-rate based on what you're already producing, the growth you have on tap, both with the open pit and the underground and the regional targets, a massive exploration program underway for the company. So a lot to follow along with in Argentina. But you're also not a one-trick pony, Mark. You've got other projects. So let's also talk about, you've officially brought in Lagoa Salgada from Ascendant Resources into the fold here. This is a VMS project in Portugal. So we're leaving Argentina. We're going to Portugal here. And this project, because it's polymetallic, has a lot of goodies, but almost half of it, 42%, is gold and silver. Then you got some zinc, copper, and tin. This is a big project. You've been following this one through the Ascendant side, and now it's all under the Cerrado banner. What are the main development objectives in the year to come at Lagoa Salgada?
Well, we have the same objective that we do with most of our projects, and that's really, to get a very base case, strong economic fundamentals, bring it to production, and then grow the assets with the cash flow that we have from the assets. So if we look at Lagoa, we did publish a feasibility study in 2023. We're now about to publish a new feasibility in August, September. Our objective is to see a significant improvement in NAV, CapEx, and cash flows. And everything that we're seeing right now has been really strong. We've come out with press releases discussing how we're completing the metallurgical testing, the optimization of metallurgical testing. That is going superlatively well. We're seeing increased grades, recoveries, reduction in deleterious elements. So there's nothing more we can ask for there. We've seen a step down in CapEx and OpEx. I think that the publication of this feasibility study, which I think, again, probably initially sometime in August will be the initial disclosure, that is going to be a big surprise to people because the economics are going to be extremely strong. The nice thing there, too, is that we're already funded. We have a UK export credit agency who are here to support that project with Banco Santander out of Spain. So that gives us a strong project finance for the debt. Sprott have come out and said that they'd like to participate in the stream for that project. We think we can get an offtake. So we think that there's a de minimis amount of equity required to bring this project to production. And basically, what we're looking at there is a project that I think will throw off, $100 million of cash flow a year, coming out of the gate in the second half of 2027. So from that perspective, again, though, like Argentina, it's a new project. We're probably going to see an expansion of our reserves and our resources in the feasibility study. There'll be a new resource estimate. And the fact of the matter is, you're going to see a significant improvement just by the metallurgical work that we've done. But we're also initiating a program with the EU. It's called Undercover. What we're looking at there is the EU are going to spend 3 million euros to do a very sophisticated geophysics study on the project. The objective is to find clusters and deposits that are well below surface, anywhere from 500 to a kilometer and a half. And subsequent to our own seismic evaluations, we believe that that there is a cluster, or there's something right below our north deposit anyway. So from that perspective, again, this is a project that'll start off at probably something in the region of 1.5 million, 2 million tons per annum, but then is going to grow significantly with the additional exploration and with the additional resources that we'll bring to the table. We're very close to Neves Corvo, once owned by Lundin, now owned by Boliden. This is the largest mine in Europe. To your point, it's a polymetallic that started off as tin and copper, and now it's running predominantly as a zinc mine. But the reality here is that we have lots of potential to see this as being what I would qualify as a world-class mine. It's still early stages, but there's, again, nothing to suggest that we can't grow this asset substantially.
When you brought up the undercover project that you're working on to look for some of those mineralization pockets at depth, do you think there's also the potential, because you have a nice mix of metals here, to apply for government funds in Europe towards critical minerals?
For sure we can. For sure we can. And we're measuring now whether, we already have the involvement of UCAF, and so the reality is that we believe that we can get sponsorship, et cetera. But right now, we're not sure that we're going to need it at this stage of our development.
Well, it's nice that I was going to ask you about the financing, which you've already pointed out, that you already have those credit facilities in place for the debt, but then you also have the potential for the stream with Sprott. So you mentioned ore coming out of the ground in 2027. So let's fill in the gap here. You're talking about putting out a feasibility study just here in a couple of months, but then production in 2027. I guess that means construction starts in 2026?
We would look at starting construction in the first quarter of 26, and then it taking, just under 18 months.
Okay, so this is a development project that could quickly become a production project. In mining terms, that seems like overnight, Mark. So that's to see.
If you look to your point, I mean, we're doing some serious evaluation of other projects out there that are somewhat similar and on a global basis. And what we're looking at, which may not have the same infrastructure benefits that we have, et cetera. And if you look at base metal polymetallic projects, they generally tend to trade at around just under 1x NAV. And, in the last feasibility study, we saw we had $150 million of NAV. I think the new feasibility will be substantially higher. On that basis, if you look at us, if the contribution, once we have funding and once it's in construction, they'll probably trade as a slight discount to that NAV, maybe 0.8 or something to that effect. But again, adding to our 130 million shares, we on a Canadian dollar basis, we could certainly see a significant incremental value to our company being added between now and the year end.
One, for those people that were worried that when you merged Ascendant and Cerrado that you're becoming more polymetallic, I guess we should point out that you already have an iron ore project in Quebec with Mont Sorcier, but in this Lagoa Salgada project, there's still a lot of precious metal. So maybe just speak to how, even if when you go into production in a couple of years in Portugal, there's still going to be a lot of gold and silver in the mix.
Well, as a combining Argentina and Portugal, we're still going to be at 68% precious metals. So from that perspective, we still are a precious metal orientated company and taking the benefit right now of the very strong environment for precious metals. But also we're involved in these critical metals. We see a very strong possibility of adding significant copper to the story, and obviously now we also, as per the project's feasibility that we completed, we have zinc, we have lead, we have tin, vanadium. I mean, we have a lot of critical metals here that we are optimistic will provide a sustained, significant, long life mine.
Well, Mark, I just want to point out too, your background. This isn't your first rodeo. You've put specialty metals projects into production before, and I'm thinking of Largo Resources with vanadium. When you said that, it kind of triggered my mind. So maybe share with people listening in that even though you're a gold producer now, this is not a foreign idea for you to put in a critical minerals project into production.
No, and nor is it for us to put any mines into production. Our team have put three projects into production to date. We've turned around other operations and both on the gold and precious metal side as well as the base metal side. So, the objective that we see, and again, right now it behooves us and it's very positive to be a gold or precious metals company. But who knows? In 5 years' time, it may be more beneficial to have exposure to base metals. So our real focus is as a junior and a small company is to buy quality assets that we believe will be the lowest cost producers in their peer group. And on top of that, have the ability to grow substantially, i.e. potentially becoming world-class assets. So we have the knowledge, we have the technical capability to bring these projects into production. Most of the projects, I think all the projects we've been involved in have been brought on time, on budget. And from that perspective, we don't see any complications with any of our projects if we were to bring them into production ourselves.
Well, that just brings up the point that you do have one more project in the stable, more as an optionality, but it could be a world-class project here. And this is your iron ore project, Mont Sorcier in Quebec. Let's just maybe have a brief comment on how it's waiting in the wings as yet a third project that could further diversify the company, but also could be a project you guys could build.
Well, a very good point. I mean, right now we're just completing a feasibility study at Mont Sorcier in Quebec. When we talk to people and we say iron ore, people go, "Oh God, iron ore," and largely because the players tend to be the big players, the RTZs, the BHPs, et cetera. But where we're playing in this iron ore space is we're playing with very, very high quality, high purity material that basically trades at a substantial premium to conventional iron ore. And there's a very limited amount and quantity. So when you look at the iron ore market in general is growing 1-2% per annum. But this high purity, high grade DRI iron ore, green steel iron ore, basically trades at a substantial premium. It's growing at around 9 to 10% per annum. There's a huge demand for the product at the moment. And so our project plays very well into that. We have 1.1 billion tons of material. It's all at surface. It starts at surface. The strip is less than 1-to-1 for the initial years. So the reality here is that there's nothing complicated about an iron ore project. Really, I think when I talk to people, the most concern that they tend to have is that we can get thrown around by the big boys. But because we're kind of almost like a steel additive, where basically, what's happening these days is DRI, or this high purity iron ore that I mentioned, is basically being blended into furnaces where they use about 10% of the iron ore for the furnaces because of the practical benefits that it brings. So from that perspective, this is not a big boy market that we're going to get thrown around. In actual fact, we'll have a good quantum, very similar to our peers at Champion that they're focusing on and moving towards. So from that perspective, it's not a complex project. We also have funding capabilities. We have, again, UKEF have agreed to support that project with TD Bank. TD Bank are very excited and they're very eager to help us with this project. So from that perspective, there's nothing complex about bringing this project into production. We believe, we'll have to see what the numbers that the feasibility study bring. We think they're going to be extremely attractive. And the equivalency of this project will be about 300,000 ounces of gold per year at a very low cost. So probably at around a $1,200-$1,300 all-in cost. So from that perspective, it looks to be able to generate substantial cash flows over a 21-year mine life, so a substantial period of time. So from that perspective, we're excited by that. As you mentioned, it's kind of the priority right now is to grow Argentina, to develop Portugal, but this is a great project that we have in the background that we're pushing as quickly as we can. Really, the biggest delays or the time consumers of this project has really been from the regulatory and permitting perspective. We know that there was a project very near to us that recently was permitted, so we don't see any reasons why we shouldn't get permitted. But in Canada, we just have a little bit more delays. But from what we're hearing from post-election in Canada, we're hearing that they're going to make a lot of accommodations to bring mines on stream, and we think we'll be a beneficiary of that in Quebec.
Yeah, it's going to be interesting to see if the rhetoric matches the action in Canada, if they do work on speeding up that permitting process. But if a neighbor has just gotten permitted, it's just a lot of people knock South America or Europe, but the actual permitting process there is a lot faster than it is in Canada, but you've got three projects. And I just maybe one last question here, Mark, on the valuation of the company. You're valued at less than 100 million market cap. Just that iron ore project we talked about underpins that market cap. Just Portugal, Lagoa Salgada underpins that market cap. That would be like you're getting no credit at all for the gold production. So just the gold production in Argentina more than underpins the market cap and then some. So why do you think it is that the market hasn't woken up to the value you have in all three of these projects combined?
Well, I think there's two things. I think one is if we look at Argentina, we do have right now a short mine life. We've got a 3.5 years. Most of the other mines in our proximity have short lives as well, and it's not an exception. People haven't really been funding and investing a lot in Argentina until these recent macro changes that have taken place. So that's certainly one thing, and that's one thing that we intend to remedy between now and the end of the year. Hopefully, get the mine life extended to 7 to 10 years, and then to your point, I think we're going to be trading at equal valuations to peers that I see trading $200+ million market caps with less return on their production than we have. And then the second thing is obviously it's important for the market to understand that our balance sheet's getting stronger. We're becoming much more financially astute. We're becoming far more financially independent. So from that perspective, we've gone out there saying, minimal to no dilution to drive these three projects, and we're doing everything in our power to get there.
Well, I think it's an interesting story to keep following along with. And when you put out the economic studies at Lagoa Salgada, that hopefully will be an eyebrow-raising moment for people looking at the project. Same thing with the economic study that comes out of Mont Sorcier. So a lot of those economic reports will then underpin what the NPV of those projects are in a more modern sense. And then if you continue to grow the gold production out of Argentina, at Minera Don Nicolas, I think that's going to only help the metrics, especially at these gold prices. It's a nice time to be a gold producer. So we'll definitely keep following along with the company and all the news flow. Looking forward to getting you back on for an update soon. And for those people listening in, if you want to follow along with the news, click on the link down in the show notes. It takes you right over to the Cerrado Gold website, straight to their news section, where you can sign up for updates or just follow along with the news as it hits the wires. Mark, looking forward as always to our next conversation.
Thank you, Shad. It's been a pleasure. All the best. Thank you.